Real estate is one of the most popular and effective ways to build wealth over time. You can invest in real estate either directly by purchasing properties or indirectly through real estate investment trusts, which is REITs. Both investment methods offer unique advantages and allow investors to diversify their portfolio, but each comes with its own set of risk and consideration. Now let's talk about, direct real estate investment, which is purchasing of property. When you invest directly in real estate, you buy a physical property. This can be residential or commercial. So it can either be purchased for personal use or as an investment to generate rental income or potential appreciation. Now, one of the key benefits of direct real estate investment is property appreciation. Over time, properties tend to increase in value, allowing investors to sell them for a profit in the future. The value of real estate is influenced by factors like location, economic trends, and local demand. Another key benefit, you earn rental income from your investment. Now, owning a rental property allows you to generate a steady income stream through monthly rent payments. This is one of the primary, ways people earn from real estate. And also in the developed nations, there is what we call the tax advantages. Real estate investors can often benefit from tax deductions on mortgage interest, property depreciation, and other costs that are associated with maintaining, the property. But there are some key considerations, that you need to put at the back of your mind when you want to go for direct real estate investment. Now, one of the first factors is the initial capital. Purchasing properties requires a significant upfront investment, often involving a large down payment and additional costs such as closing fees and property inspections. You also have the management responsibilities. If you're a landlord, you need to manage the property, handle tenant relations, maintain the property, and potentially deal with legal issues. This can be time consuming and expensive. Property value can fluctuate based on market condition. This is what we call the market risk. Economic downturns or change in neighborhood desirability, can reduce the value of your property or make it harder to rent out. Now, when there's an economic downturn, people tend to move from one location to another, thereby deserting certain neighborhoods. So that alone can reduce the value of your property or make it harder to rent out. Or like in developed nations, there are some areas where the access to public transportation is not there. So it is difficult to rent it out, and thereby making these properties reduce in value. That means if you don't have your own personal vehicles, there are some certain areas that you cannot live in. So this can affect, and make the fluctuation effective. So these areas or economic downturns can increase the desire for individuals that want to stay or live in that particular environment. So economic downturns or change in neighborhood desirability can reduce the value of your property or make it harder to rent out. Because when the property that you are having is in a location that is not favorable or that is not motorable, that has no means of public transportation, definitely it will reduce, the desirability of individuals wanting to stay in that particular region. This brings us to the indirect real estate investments, which is the real estate investment trust, which is REITs. If you prefer not to deal with the complexities of direct property ownership, you can invest directly in real estate through REITs. A REIT is a company that owns, operates, or finance income-producing real estate. When you buy shares in REITs, you own a portion of the real estate portfolio and you earn income through dividends. So this involves you buying shares or stocks of certain real estate companies that are listed in the stock exchange markets. Some of the key benefits of investing in REITs has to do with diversification, because it allows you to invest in a diversified portfolio of real estate assets, including residential, commercial, and also industrial properties. This spreads your risk across various properties. So you can decide to be involved in different real estate, companies, buying stocks or shares from different real estate companies to mitigate against risks of market downturn and other factors that might affect your investment. So unlike the direct property investments, which can take time to sell, REITs are traded on the stock exchange, so making them highly liquid. So you can buy and sell shares relatively easily. So when you buy a real estate stock from the stock exchange, regardless of how much you invested in purchasing that particular stock, it is relatively easy to sell, and you can also buy easily. All you just need is a platform, a stock exchange platform where you can get access to purchasing, these real estate stocks in particular. Unlike having a physical property, whereby if you want to put it for sale, it might take you time to get a buyer. And most times depreciation and market devaluation and all of that kicks in, and the value of the property diminishes. So, but in REITs, when you are trading on the stock exchange, it is just but one click. So lower capital requirement is needed when you are purchasing a real estate that is traded on the stock exchange market. So you don't need large sums of money to invest in REITs. You can buy as few or as many shares as you want, making it accessible for small investors. So if you don't have the full capital or the financial wealth to do, to get yourself a physical property, you can as well, as a small investor, get access to buying, from the stock exchange. And another key benefit, when it comes to buying a REIT from the stock exchange, hands-off investments. Since REITs are managed by professionals, you don't even have to worry about the day-to-day operation of the properties, such as maintenance and tenant management. All you just have to do, buy a portion of the shares. The REIT management, they know what to do. All you just have to do is sit back, receive your dividends, pay out, and when you are done, or when you are gotten what you want, you can as well sell your investments in the stock exchange market. But another key factor to still consider when you talk about investing in REITs is risk management. The value of risk shares can fluctuate with the overall stock market. While provide exposure to real estate, they are still subject to stock market volatility. So the market can go up, can come down, and all of that. Dividends from REITs, take notes, are typically taxed at a higher rate than qualified dividends from other stocks, which can reduce overall returns. Because REITs, they pay dividends on regular intervals compared to some other stocks that pays probably, quarterly, bi-quarterly, and all of that. But when it comes to real estate investment trusts, majority of them, they pay you dividend virtually every month. So depend on your investment, that determines the substantial dividend that you get in return. So when you invest in a REIT, you don't have control over the properties, the funds owned, or how they are managed. Your return depends on the decision made by the managers. So that is one of the disadvantage of investing in REITs in the stock exchange. You don't have control over the properties. How they are managed is none of your business. Your return depends on the decision of the real estate, managers. So whatever you get in return, they decide. Real estate can be divided into two main categories, which is residential and commercial. Now, each type has its unique characteristics and may appeal to different types of investors. Now, residential real estate, which includes single-family homes, apartments, townhouses, and multifamily buildings. So residential properties are generally more accessible to beginners, as an initial investment can be lower compared to commercial real estate. And also, there is a wider market, for rental tenants. Due to the housing crisis that we are facing across the globe, the rise for apartments and homes is on the high, especially when it comes to residential homes. Everyone is looking for an apartment, a residential house, and all of that where they will reside. But there are shortage in these markets. Residential properties are generally more accessible to beginners, as the initial capital or investment can be lower compared to commercial real estate. And there is wider markets for rental tenants. So if you are an investor or an upcoming investor trying to consider which sector to involve yourself in, the residential properties are more accessible for beginners because it requires low investment capital to begin with compared to the commercial. So rental income from the residential properties is typically more stable because there is a constant demand for housing. People need a place to stay regardless of the economic condition. So whether the economic condition is good, whether it is bad, people are always in need of a place to stay. They are always on the lookout, searching for where to stay. So residential real estate may require less expertise to manage, especially if the property is single-family home. Tenant turnover tend to be higher, but the management tasks are generally less compared to that of commercial properties. So managing a residential real estate is more, economical and less complex than commercial properties. Commercial properties, include office buildings, shopping malls, warehouses, industrial properties, and other businesses used for profit-generating purpose. Now, getting involved as an investor requires a high initial capital investment, because commercial properties typically require a larger initial investment and more significant expertise. They also come with higher risk, as the success of a commercial property is closely tied to the economic health of businesses and industries. So compared to residential homes, whereby whether the economic condition is good or not, everyone is on the lookout for a rental apartment. But the success of a commercial property is closely tied to economic health of businesses and industries. While commercial real estate can offer, higher rental income, especially if the property is leased to long-term stable tenants. But rental demand can be more volatile, as businesses may struggle during economic downturns. Commercial properties tend to have more complex management requirements due to the need, for managing large tenants, longer leases, and often more maintenance and regulations. But they tend to provide a steady source of income once they are established. So one of the most attractive aspects of real estate investing is the opportunity to generate passive income through rental properties. But however, owning and managing rental properties come with both benefits and responsibilities. In as much as we're emphasizing more on the benefits, it also has its own, responsibilities that comes along with it. Now, some of the benefits of rental properties includes, steady cash flow, because renting out a property provides you with regular, predictable monthly income from tenants, whether the economy is good or not. And over time, this property may increase in value by appreciating, allowing you to sell it for a profit or use it as equity to purchase other properties. And as a landlord, you can deduct various costs associated with property management, including mortgage, interest, property tax, insurance, and repair expenses when you file for returns. But this typically, occurs in developed nations. But in developing nations, we are still yet, to arrive at that particular destination whereby you can get deduction, from various costs that you incur in the process, of your investments. The key responsibilities of rental property ownership includes, tenant management, because you will need to screen tenants, handle leases, and address any tenant issues such as late payments or maintenance costs, because you need to screen tenants. If not, you end up having tenants that may refuse or may not want to pay, their rent as at when due. So that's one of the responsibilities that comes with property ownership. You have to deal with it, screen them, handle leases, address tenant issues, and all of that. And also the property maintenance comes in play. Maintaining a property is essential to keeping tenants happy and retaining the value of your investment. Because most, landlords, they pay deaf ears, when it comes to maintaining their property, even when you remind them on regular occasions. But they tend to not, want to keep their tenants happy. Thereby, most tenants end up not wanting to pay their rent as at when due. So this includes, regular upkeep, repairs, and ensuring that the property meets safety standards. And also, as a landlord, you must comply with local laws regarding tenant rights, eviction process, and property safety regulation. This is one of the, hardest things when it comes to being a landlord. You have to comply with local rules and, tenant rights when it comes to the eviction process, safety regulation, when it comes to late payment, because you can't, send your tenant out of the house just like that for refusing to pay their rent as at when due. There are so many processes that goes along with evicting a tenant from your apartment or from your house. So whether you choose direct real estate or opt in for the convenience of real estate investment trust, which is traded in the stock exchange, investing in real estate can be a powerful way to build long-term wealth. Residential real estate tends to be more accessible and offers steady rental income, while commercial properties provide higher income potentials but require more expertise. So by understanding market trends, property value, and rental demand, you can make informed decisions to succeed in the real estate market. I hope you find this video useful. If you do, please like, share, and subscribe to this channel for more videos. Until we meet again, it's your boy Young Diamond. Peace.